Starting this webinar, we'll look at typical processes that institutional money managers use in order to create and manage their portfolios. Now, these processes are generally universal in nature, and they are followed in much of the asset management world. And we will cover every process starting right from the beginning, from how money managers design their portfolios, how they choose the securities that would go into those portfolios, and how do they do the valuation for allocating stocks in the portfolio, how do they construct the portfolios, and what framework they use in order to manage and track the performance of those portfolios. And last but not the least, we'll also look at how they communicate the performance to their clients. So now, what you are seeing here is the most generic form of the investing life cycle, followed by most institutional money managers, whether it's in India or in the US or in Japan. So globally, institutional money managers use some version of this investing life cycle. So it goes as follows. So first, you identify your benchmark. That is, if you're starting a new fund, you identify what benchmark you're going to manage the portfolio against. And then once you identify the benchmark, you get a fairly large universe of companies which would go into your portfolios because you're managing your portfolio against that benchmark. Once you have this large universe, you filter that universe based on your criteria, and then you analyze those companies from that universe in order to create a smaller investable shortlist or an investable basket. So that's the criteria you use. You use various parameters based on which you filter that large universe into a investable universe. Then you analyze the companies, rather you analyze the stocks of those companies in order to find out a sort of a ranking scheme. And that ranking scheme tells you which stock in that universe, in that investable universe, is the most attractive, and which stock is sort of the least attractive, so that you can allocate your money across those securities. So you can allocate larger sum to companies which are at the top of the list, and smaller sums to companies which are at the sort of bottom of the list. These companies do figure in the portfolio, but then as opposed to an equal weighted portfolio, companies which are lower in the ranking scheme would get a lesser amount of money, and the companies which are at the top of the ranking scheme would get a larger share of the money. And then once you do the construction of the portfolio, you manage the portfolio on a daily basis, and then you take corrective measures it is needed, and then you measure the performance, whether on a monthly basis or on a quarterly basis, and then you communicate that performance to your clients. So of course there may be minor variations of this process from manager to manager, but most institutional managers follow some version of this process. So if you can see that this is broken down into specific tasks, and generally speaking, each of these tasks are handled by separate teams. So the reason being that it is not possible for the same set of people to be doing everything, and so there is a sort of a division of labor, if you will, and it also allows a team-based approach to investing, and team-based but collaborative model. In most institutional investors or institutional money managers use a team-based approach for getting maximized return with respect to risk. So now we will look at these individual tasks one by one and see how they fit into the larger scheme of things. So the first thing is to identify the benchmark. So how do the money managers identify what benchmark they're going to use in order to manage their money against? So let's say you're starting a new large cap fund. A large cap fund would basically consist of securities which are of a certain range in terms of a market cap. So in India, SEBI has clearly defined which companies fall under the large cap category, which companies fall under mid cap, and which companies fall under small cap category. And of course, you have these micro cap secure stocks. So when a company when a money manager starts a new fund and says that, yeah, I'm going to have a large cap equity fund, so we know that there are well regarded and well followed indices or benchmarks which consist primarily of large cap stocks. And so most money managers having large cap equity manage against the Nifty 50 or the S&P 500, etc. And but that is not to say that a large cap equity fund will not or should not invest in, let's say, mid cap. So it depends on money manager to money manager. But most of the portfolio, maybe about 80% or 85%, would be invested in large cap stocks, and a small amount may be deviating from the large cap sort of rule. And so some part of the money may be invested in mid caps, some part may be invested in small caps, and even some amount of money may be invested in debt securities, like it may be in cash, kept in cash in the form of money market instruments like T-bills, etc. So once you define the benchmark, you are very clear as to what are the kinds of securities, well, companies that will go into your portfolio. So you get this large list, and out of this large list, you apply certain criteria which is internal to every firm. You apply a certain criteria, and you filter out those companies which have passed your quote unquote test, so that becomes the investable universe. So it's not necessary that the larger universe, every company in the larger universe would figure in the ultimate portfolio that you are going to manage. So out of the larger universe, which could be defined once you define your benchmark, out of those securities or companies, you apply your own filtering mechanism, apply certain criteria, and then you get a investable universe. So the now the you construct the portfolio, and so there are a variety of indices that exist for every kind of portfolio. For example, Nifty 50, S&P 500. If you want a larger, if you have a larger fund that is a broader market fund index, then you have Russell 3000 or Nifty 500. And then if you have a global or international fund, you have the MSCI World or MSCI Asia or MSCI Europe. Then you have a bond fund, for example, Bloomberg Aggregate Bond Index. Or so it is the job of the fund house and the manager to determine which index they will be managing the fund against. Yeah, so in India, for example, a large cap fund would be managed against the Nifty 100, which is an index made up of the top 100 companies out of the Nifty 500 by market cap. Similarly, a technology fund will be measured against the Nifty IT, Nifty Technology Sector Fund. Okay, so the benchmark is basically a passive fund in the sense that there is no fund manager overseeing the performance of the Nifty 50 or Nifty 100, etc. So the active money manager selects his portfolio securities out of this universe, and may also, as I said earlier, may also select securities from elsewhere. Okay, so now we have understood how the benchmark is arrived at. So out of this benchmark, if you see here, the universe is selected, and out of this universe, the investable universe is selected. Now, I mentioned about criteria. So, what can be those criteria? Some of these criteria are as follows: market cap. So, the manager may say that I'm running a mid cap fund. So, I'm going to you have companies whose market cap is below so much or above so much. So, I'm going to have companies in this range. And then liquidity. Liquidity means how available a security is. So, for example, if you are going to buy a security, then there must be enough sellers, or if you want to sell a security, there must be enough buyers. So this is a very important criteria that managers use in order to construct their portfolios. So, for example, one of the criteria could be yesterday's trading volume maybe should be larger than the average trading volume for the past 3 months. Okay, so that could be a criteria that money managers may use in selecting securities. So risk is another very important aspect. So, for example, price volatility is a very important factor in determining the risk of the security. And so you may decide that you don't want securities whose standard deviation of price is above a certain value. And then, of course, I talked about sector and industry. So you want to construct a portfolio whose sector maybe in IT or infrastructure or consumption, etc. And then there are other criteria that are more client specific in the sense that some clients may not want you to include securities, or companies who make cigarettes or alcohol or something like that. And then so that leaves out companies like ITC, etc. So these can be the some of the most widely used criteria in order to select your investable universe. So once you select your investable universe, next is to analyze. Okay, so now as I mentioned earlier, so there are certain criteria based on which you analyze companies. So companies can be analyzed based on, for example, growth. Then you have profitability. Then risks. What are the kinds of risks facing those companies? And then the financial health of those companies. And then the strength of the management and the good governance that is applied to those companies. So these are what people also call the five pillars of company analysis. But the thing that you have to keep in mind is that you analyze companies, but you value the stock. So how do you do value? So this is probably most familiar with most people in the financial industry who are getting into the industry is the valuation. So how do you value stock? There are different widely used valuation models. So, for example, dividend discount model, the multiples model, or comparable companies model, or the discounted cash flow model, which is most popular, or companies may use a proprietary model in order to do the valuation of stocks in the investable universe. So after you do the valuation, you get to know what is the best company in terms of valuation. And obviously, if you are running a value fund, then the most undervalued company or the security is the most attractive. So if a company, all other things being equal, if a company is available to you for a lesser price than another company, then it's a sort of it's a no-brainer in order to decide which company you would like to buy. So that is the end result of a valuation. So whether a security is attractive enough to buy. So even though that security may be in the upper end of the ranking scheme, if the price quoted in the market is way above the intrinsic value of the stock, then it doesn't make much sense to buy that security. So you may want to wait till the stock price comes to somewhere near the intrinsic value, or this is how you analyze securities and determine which security is a good buy. because ultimately you are looking for a long-term outperformance. So as the saying is, buy low and sell high. So you want to buy a security at the lowest available price or the lowest possible price. So these are after valuation, you construct your portfolio. So you have a list of stocks in the order of attractiveness in terms of valuation. And so now it's time to put those securities or you allocate your money in across those securities. So, for example, you have 1 lakh to invest, and out of this valuation exercise, you have maybe I don't know, maybe 50 stocks. Okay, so now you have to allocate this 50 stocks, rather allocate this 1 lakh across 50 stocks. So if you're running an equal weighted portfolio, then each stock would get 2000 rupees. So you just divide 1 lakh by 50. But however, of the valuation model, so for example, you want to break down the portfolio into three parts. One is stocks which are very attractive based on your valuation model. So let's say about 20 stocks are in the upper end of the valuation ranking scheme, and then let's say there are 20 stocks which are in the middle, yeah, rather are fairly valued, and then you have 10 stocks which are highly overvalued. Okay, so obviously you want to put more money into stocks which have a larger or which have a longer runway, so that give them time to appreciate in value. And so you want to invest more money in undervalued stocks in those 20 stocks. So for example, let's say instead of 2000 you want to invest 2500 in each of these 20 stocks. So you make a decision to do that. Then you have 20 stocks which are fairly valued, which are neither undervalued nor overvalued. So you put in the 20 stock, 2000 rupees in each of those 20 stocks, as you would in an equal weighted portfolio. And the 10 stocks which are highly overvalued, so you put maybe a lesser amount. So you put less amount so that the total amount invested could be 1 lakh, and so this is how you allocate your money across your portfolio. Now, another thing that you look for is the risk return profile. There are specific financial theory models that help you analyze, what is the risk return profile of the portfolio, and how do you weight each security so that you get your desired risk return portfolio profile rather. So you need to look at systemic, that is market risk versus security specific risk, and then the question of diversification. So you don't want to have securities which are exactly similar. You want securities which have a negative correlation or no correlation among them. So depending on that, the weighting scheme and the allocation across the portfolio will happen. And then the question of leverage, whether you are going to take additional, you're going to borrow money in order to gain the leverage, and so you have advantage of higher returns. But generally how portfolio construction and allocation takes place. Then you come to management of the portfolio on a regular basis, on a daily basis, in fact, and tracking. So what do you look for? You look for macro signals that can affect your portfolio. Then you have security specific news. So for example, like Adani and Hindenburg. So you see immediate, there was a huge drop. That's a different thing that the stock came up and later on. But the thing is, there are certain security specific news that can have a very bad effect on stocks in your portfolio. So you need to watch out for that. Then you have market news, then regulation. So for example, if SEBI or the government comes up with new policies or new rules. So, for example, recently, in fact, a couple of days ago, the Supreme Court gave a decision regarding um, retrospective taxes on mining companies that states can charge. So that has a bad effect on a lot of the mining companies. And so that if your portfolio is heavily biased or heavily weighted towards mining companies like Tata's or Hindalco or Vedanta, etc. So that might be a problem for you. So you need to closely monitor such news and understand what is the impact of such news on your portfolio. And then you need to always look for, or rather, you need to watch for new money coming in or redemptions going out of the fund. And so, how do you manage that? And how do you sort of allow for customers to put in new money as well as to redeem their shares and yet maintain your returns? So that's a challenge. So it's not as if, once you created the portfolio, you can sit back and relax, but it's a constant process of being watchful to what is happening, whether in the broader market or whether, say, security specific to companies in your portfolio. Then you have performance attribution. So, for example, if you are beating the index, and so you need to really understand why I am beating the index, whether it's just sheer luck or whether you can attribute that alpha or excess return to some skills that knowingly or unknowingly that have come into the picture. So whether it's a market performance, as they say, a rising tide lifts all boats. So if every fund is also doing well and you are also doing well, then it's no big deal, because rising tide lifts all boats. So why should customer invest money with you versus Joe on the street? So that is something that you need to understand. And then you need to understand whether it's because of a sector, whether you have analyzed different sectors and the business cycle that different sectors are going through. So, for example, IT is not doing that well. Housing and real estate is doing very well. So, let's say your analysts have had earlier done some research and they have recommended that you be in this sector. So you need to understand, yes, I was biased towards this sector, and so I've bought companies in this sector, and that is the one of the main reasons for my outperformance. And so, or just by sheer luck, I may have liked this sector, and I saw it on CNBC that real estate sector is going to be in a boom cycle, and so quickly bought those companies in that sector, whether it's that or whether it's some real skill. So that you need to understand, because clients need to understand, whether there is really skilled people who are managing the client's money, or it's just random sheer luck. So, or security selection. So, having done the analysis for each security in my portfolio, or in my investable universe, whether I've done the analysis and whether I'm able to clearly foresee or forecast that company A or say or security A is going to do very well in the near future and in the long term future. So that's something that the clients need to understand, whether you have the skill set in order to analyze companies. So that is something. And then how much of the portfolio performance you can attribute to security selection, and of course how much of the performance has been weighed down by risk. So you can even quantify the amount of risk that the portfolio is carrying. So over time, if you see that the risk profile of the portfolio is increasing, that's not a good thing. So if you see that fine balance between risk and return, if you are maintaining that to the client satisfaction, so that's a plus point. And so you also need to be very, very cognizant of the risk that your portfolio is carrying. And believe me, many, many institutional money managers have teams which only look at portfolio risk, and they are being monitored like a hawk. Okay, so then let us see an example of this process. This is a momentum fund, which is managed by the Quant Fund. It's a very well-known mutual fund company. And so, how do they go about the investing process? So, first they identify identify the universe or the index. So, they've chosen the BSE All Cap Index. So, what is the BSE All Cap Index? This is the BSE All Cap Index. This has got companies across the market cap spectrum. And so you see here, right from various market caps, there are a bunch. So this is the index that the Quant Momentum Fund is managing against, or they manage this their portfolio against. And this is the large universe. So out of that universe of the companies, then you apply your criteria and you create a investable universe. So what it says that we have constraints and desired risk attributes, and they remove the stocks which do not meet their thresholds. And so, as I said, this is a even though this is so this is a BSC all cap index, so which it consists of large cap, mid cap, small cap, and even micro caps. And so for micro caps, what they are saying is that they are evaluated separately, as liquidity is paramount to our strategy, because micro caps do not have good liquidity. So they put extra effort in understanding and as they say that we may have micro caps in the portfolio, and so if at all they want to have a micro cap stock, they apply an extra level of security or other analysis so that it passes their liquidity constraint. So after that, you get the investable unit by applying these thresholds and applying these filters. You get the investable universe. So what they do is they apply a quantitative model, which is called the VLRT framework. And so it's a scoring methodology. So it's out of this, then you get, by applying this methodology, the end result, what you get is a ranking scheme, a score. So every stock will have a score. Obviously, the number one score company is the most attractive, and attractiveness goes lower and lower as the company rank increases. And so from there, you create the investable basket. So stocks further filtered through this model are the investable part of the investable basket. Then you do an allocation. As I said, the weightage scheme. So their money, how to allocate the money across the stocks in the portfolio. So obviously, rank one stock will get higher weightage, and so more money will be invested in the top ranked stocks, and lesser amount of money will be invested in the bottom ranked stocks. So that's how you do the allocation, and there are lots of models. There are lots of quantitative formulas and programs that help you to do that in a fraction of a second. You have constant tracking and looking at opportunities to see if there is another attractive stock that has come into the picture. How do you take advantage of that opportunity? So this is done on a continuous basis. So this is also in quant funds example. This is a proprietary momentum model. So it closely monitors the market parameters and makes adjustments based on the initial data points. So you can see end to end how the investing life cycle happens in this quant fund, that is the momentum fund. Next, we look at another fund, which is the Mirae Asset Large Cap Fund. It's quite old, started in 2008, and it says that it's a large cap fund, an open-ended equity scheme, predominantly investing across large cap stocks. Okay, and this is where it gets interesting. Now it says that we will predominantly invest in large cap stocks. So let's see. So now here, as we drill down, we see that what they are saying is that it invests minimum 80% in large cap stocks. Okay, and it's not a pure large cap fund. So minimum 80% large cap stocks. So what happens to that other 20%? So if they invest 80%, what happens to the other 20%? Um, Here he says that a few conviction mid-cap ideas up to a maximum of 20%. So what they are saying is that a maximum 20% can also be in mid-cap stocks, okay, in which they have very good conviction. And then it says that they have flexibility to invest across sectors and themes. So they are sector and theme agnostic. Okay. And then the other criteria is the high quality business at a reasonable price, and then holding the same over an extended period of time. And then which have competitive advantage. So these are all very sort of abstractions, but then there are models that can translate these abstractions into actionable data-driven actions. Okay, so now we know that minimum 80% large cap stocks, also a few mid cap stocks, flexibility across sectors and themes. And then here, further, if you see, the fund can also invest up to a maximum of 20% of its assets in debt securities. So, though it is called large cap equity fund, um, we saw that that has been diluted to include mid cap stocks also, and now it is further diluted to include debt securities and money market instruments. Okay, so why money market instruments? So being that that's the closest to keeping the money in cash. Why do you want to keep money in cash? Because you need what they call sufficient gunpowder, so that in case there is a sudden opportunity to buy a stock, then you it takes time to sell. If you're fully invested, it takes time to sell a security and then buy this particular security. Whereas in money market, if you hold it in the form of money market instruments, you can do that in a jiffy, and you can free up your cash, and immediately you can buy the securities that has come into your opportunity window. And so as of 28th of February 2023, the fund composition was 82% large cap, 11% mid cap, 4.3% small cap, and nearly a 1% held in cash or cash equivalents. So you can see that even though it is called a large cap equity fund, you can see that it really has a wide cross section of instruments in the fund, and there is nothing wrong in this as long as and this is a sort of a fund prospectus, as long as they are very transparent. And anyway, since 80% is large cap equity stocks, or rather large cap stocks, okay, and and so they are allowed to do that by SEBI. So again, this is just a recap, 80% in large cap stocks, and then see why they want to capture the consistency of large cap stocks with a few mid cap, with a few conviction mid cap ideas, and then including or debt instruments for income, and also hold some amount of money in the form of cash, in the form of money market instruments. So you see in these two widely different kinds of examples, how do they choose the index and how do they create their portfolios. In the subsequent slides, we will look at each individual function, if you will, including analyzing companies in valuation, then performance, then allocation, portfolio allocation, then performance attribution, etc. So we will cover the entire life cycle of an investing process in an institutional money manager.